Good evening, everybody. This is Ron Wheeler. I'm the manager of options trading here at VectorVest, and it's my pleasure to bring you tonight's special presentation. One symbol, one trade type, one set of rules for consistent income. Now, over the years, people have come to me and said, Ron, how can we put together an income-generating trading system that can take, in some cases, at least amount of time as possible? Well, through the years, I've put together a system, and I've called it the bulletproof system in 15 minutes a day to generate income. And once you get comfortable trading and once you get comfortable with the rules of the system, you can trade in as little as 15 minutes a day. But for some, even that is a commitment that they may not necessarily want to take. Well, what if I told you I could take that 15 minutes a day and really break it down to 15 minutes or less a week? We can do it. One of the things that clients come to me and tell me is they want to implement this system, but they really can't find trades easily. It's the needle in a haystack. There's thousands of symbols out there, thousands of different options analytics. How can they bring this down to something very, very simple? They don't want to take a lot of time to create this income. They want to spend more time doing the things they love and less time sitting in front of the computer looking for different trading opportunities. Well, the first step in creating a system that doesn't take a lot of time is to first have a system in place. Now, this is the system that I operate under for all of my income trades, whether it's the one symbol approach we'll talk about tonight, or if I'm just looking for stocks in general to create income on. I start with market direction. One of the things that I do for income is I only trade in the direction of the overall market. So right now we're in a bullish phase. I've been trading bullish. Through the sell-off that we had through February and March, I was trading bearish. I only look for stocks or markets in the direction of the overall trend. Now, Stock Finder, this is where it can start to get a little bit more difficult. Not difficult in finding the trades, but more time consuming. We have to go through thousands of stocks that are optionable to try to find graphs and fundamentals that match the overlying market. So that can be difficult. It can take a lot of time. Once we do that, we find the options, thing that gives us the highest probability, the most credits. We do the setup, the trade management, where we know where to exit, know where to end with profits, know how to adjust or mitigate. And finally, it all becomes a lot more easy if you have tools for speed and efficiency. Well, let me break this down for you tonight with one simple trade on one simple market. That can take out most of the steps and most of the time it's going to take you to set up these trades. We will still follow along with this overall trading system approach, but we'll reduce it down to simply one trading symbol. So to keep it simple, we are going to trade S&P 500 index options. This makes it easy. Now, what is an index? What is an ETF? You may be familiar with either of these or both of these. On the major market index, such as the S&P 500, even the NASDAQ and the Dow Jones, there's an ETF, or an exchange-traded fund, which is a stock. They pay dividends in some cases. They are exercised as stock, and they are basically tracking stocks of the overall index. So again, there's the SPY for the S&P 500, the QQQ for the NASDAQ, the DIA for the diamonds, OEX for S&P 100, etc. Well, there's also such thing as a cash index. Now, the cash indexes, the main differences are they do not have settlement. They don't have what's called early settlement or early assignment. So what that means is this. If I were to go out and buy an option based on the SPY, there is always a risk of assignment. I could be forced to sell stock. I could be forced to take stock on. A lot of income traders, even though the risk of assignment is insanely low, by the way, in over a decade of trading index options and trading stock options in general, I have never taken on a stock as long as you follow the system. The fact that these options cannot be assigned before the expiration date gives traders comfort. They're not worried about, what happens if it goes in the money and I get early assignment. The biggest advantage, in my opinion, of an index option is the fact that they cannot be assigned early. They are settled in cash after the last trading day of the option. It's a very, very big advantage. Another advantage of index options is they are generally priced higher than the underlying ETF. For example, an SPX option is 10 times the value of an SPY. You can control and trade a lot more dollar amount with a lot less position. So there's lots of advantages versus index and ETFs. I would call you to the CBOE's website on this for the SPX index options. There's all the different benefits, the cash, the settlement options, the large notational size, which we also talked about, the fact that they're global trading hours, there's flexibility in the contract. And one of the other things that I personally like, and you will also like as well if you're trading this not in an IRA, but in a regular trading account, SPX options are taxed differently. You can see that in the lower right-hand corner where it talks about the 60/40 tax treatment. And there's a little bit more information on the CBO's website which talks about that treatment. Beautiful tax advantages for us on these index options. And again, that is index specific. That is not in the ETF. So in the ETF, it is taxed. If you read that, it's taxed as ordinary income, whereas the index option is taxed at that 60/40 treatment. Okay, so it's a much better tax savings for those of you trading outside of an IRA. Now, if you're wondering, if you saw my special presentation all the way back from January 31st, I talked about printing money from weekly income trades. What you're going to see tonight is a variation of that special strategy. Now, what is the difference between what I will show you tonight and what I showed you back in January? This system is a shorter term variation of our longer term income system we also teach and use. So we have two models for our SPX income system. Now, the advantages of this shorter term module is, number one, these trades do not need repaired. There's no mitigation or adjustments needed at all. You simply enter the trade, you either make money or you exit with a loss. There's no adjustment, there's no mitigation, there's no trade repair. These trades are much shorter term. So we're going to be selling options generally between 11 and 25 days to expiration. These are going to be shorter term duration trades. So this is more of a consistent weekly income that you can use. These trades also, because they don't have any repair or mitigation needed, they have a much better reward versus risk than the system I showed you back in January. Now, ultimately, which system is better? This is one of those great times as a trader. I can simply tell you, yes. Both systems have their merits. Both systems have their drawbacks. The system I showed you back in January has historically over an 85% success rate, a very nice rate of return over the years. The downside of that system is it does require trade repair and mitigation to make it successful. This system has a much shorter duration, no risk or no repair risks on this one. The downside of the shorter term system is you essentially get less room to play in the market. Our longer term system gives you a very, very wide buffer, if you will. If the market's at 3,000, we may be selling options at 2,800. If the S&P is at 3,000 with this system, we might be selling them at 2,950. Both systems have their pros and their cons, and that's why the beautiful part of this is we have systems that meet the criteria and the needs of any one of our traders. I have traders that love the short term, and I have traders that love the longer term system. They both work effectively. You just have to find out which one you fall into the best. So let's talk about this first. I talked about you have to have a system approach to this. The first thing we have to do is find the market direction. You know, the markets can go up, they can go down, they can go sideways, kind of like a roller coaster, right? One of the systems that I have come to love here at VectorVest is our market timing system, the DEW. I love using the DEW for my options trades because over the years it has provided the most stable, slower moving system that allows my options to work well. So what I'm showing you on this graph here, this is the DEW from 2020. So if you take a look into the early part of January, we had a DEW up signal until we had a down signal for only a day. followed by the remainder of January into where the market sold off for the Corona sell-off and a DEW up, and then finally a DEW down through the huge market sell-off we had. And then currently, as we're sitting today before the market closes, we are back into a DEW up. So what I do is I assess the DEW situation for the day. If we are in a DEW up, I place a bullish trade. If we are in a DEW down, I place a bearish trade. It's as simple as that. No, the market's up today, but DEW down. The market's down, but DEW. It doesn't make a difference. You assess what the DEW is for the day, and you place your directional trade in accordance with what the DEW says. Now, what we're also going to focus on is selling low probability SPX options. So let's talk about that. Remember earlier in January, I talked about how when you buy a market or sell a stock or sell a market or sell it doesn't matter what you're trading, an index for a market, an individual stock. When you buy or sell that security, you essentially have a 50-50 chance of success based on statistics. Now, of course, we all know that using VectorVest with market timing and picking good stocks, we can boost that up quite a bit. But from a pure statistical standpoint, if you were to buy a stock, it's essentially a 50-50 proposition. What we are going to do is become an option seller, and if we're bullish, we are going to target options that have less than a 35% probability of getting hit. So what that means essentially is this. I took a little screen capture of the S&P. This is back from early April. If I was taking a trade on a day like this day right here, essentially when the market's at 2663, I'm going to pick an option that has a 35% probability of that strike price being hit before expiration. So in this instance, I might be selling an option around 2550. Now what that means is this. As long as the stock or the market stays above 2550, I will make money. If the stock goes sideways, I make money. If the index or stock goes up, I make money. As long as we stay above, in this case, 2550, I will be profitable on this trade. That gives you a 65% probability of making money. Now, if you're wondering, probability. Delta is an option Greek that is used for two things. Number one, it's used to tell you how much the option will increase or decrease in price based on every dollar underlying move of the stock or market. Delta can also be used as a proxy for probability. So if I look at a stock option and I see that the delta is 35, that means that that strike price only has a 35% chance of getting hit to expiration. Now again, we are selling options generally from about 11 to 25 days using this shorter term methodology at about a 35% probability. Now, if you're bearish, it's going to be the same approach. If we think that the stock or the market is going to decrease in value, and again, for this, we're trading the SPX, so in this case, it's going to be the index, we would go out and we would find an option that has a 35% probability. In this case, I'm into the early stages of March and the market sell-off. The market's at around 2750. I would go and find my option anywhere from 11 to 25 days away with a 35% probability. In that case, it was around 3,000. And you can see as long as the market stays under that price, we can make money on this trade. Okay? Now, over the last 4 years, this system has had a better than 60% success rate. And that's good. That's what we want to see. We're selling options that statistically have about a 35% chance, and when we go back there and actually test it, we find that it actually does have a better than 60% chance of success. There's always going to be a variance between the statistical and the actual trading. So that's why we go back and test. We don't just say 35% chance of success. We go back and test it to make sure that it's accurate. Now, once you identify the trade, we want to make sure that that trade is managed properly. So let me show you how this works. We're going to exit the trade at 50% profits. So if I sell one of these spreads for, let's say, $1, I'm going to buy it back later on for 50 cents. I'm going to exit the trade at a 50% profit. History has shown us that by exiting one of these spreads at 50%, you will make more money overall and you will have a higher degree of success than trying to make more money. Sometimes getting out of the market quicker makes you more money. Now, when these spreads go against you, you have to have a plan in place ahead of time and you have to be prepared to act. We simply exit the trade if the S&P 500 index falls below the strike price that we sold. Now, what I want to do before I get into some of the rest of this, I want to actually take you through a setup using today's markets for example. So I'm going to switch to my VectorVest Options Pro software, and I'll just take you through the concept of what we're looking for. Now, as of today, the market is still in a DEW up. I know that the market is down quite a bit today here on Friday, but let's go and take a quick look at the market timing graph. Here's our market timing graph. And you can see that the DEW started on April 6th. And even though the stocks are down today, the market's down considerably, it is still, as of today, a DEW up. So I would go out into an option chain and I would look for an option. And again, it can expire anywhere typically between 11 and 25 days. It really doesn't make much of a difference in the history and in the testing of the system. Now, are there advantages of going shorter term? Are there advantages of going longer term? Generally speaking, if you go with an 11-day option, the trade will end quicker. You will see profits or losses faster. If you go out to the longer end of the spectrum at 25 days, the disadvantage is the trade takes a little bit longer to get to profits or losses. But the advantage is you get a lot more room to play with and a lot more buffer to be wrong. So let me show you how this works. Let's say that we're placing a put trade today. Step number one is I go out into my puts and I look for a put that has about a 35% probability. So let's take a look. If I use the May 15th options, I'll scroll down here using that delta column, and about right here I'd say is where I would go, right in that 35 area on the delta. I'm going to go ahead and sell a 2760. All right. Now, by selling that 2760, it gives me about a 65% chance of success based on statistics. We do not sell naked options. That's bad because that leaves you with a lot of risk, not only monetary risk, but volatility risk. If the volatility of these things goes very, very high, it can leave you with a much larger loss than normal. So we do what's called a bull put credit spread. By selling the May 15, 2760, I am technically obligated to settle that on cash on the day of expiration. But what I can do to reduce risk, to reduce margin, and make this trade safer and lock in a maximum risk is I buy insurance. So what I do is I go 10 points below the price that I sold, that happens to be $27.50, and I buy my insurance. So I'm selling a $27.60 and I'm buying a $27.50. I'll go ahead and add that to one of my risk graphs, and I'll show you how this trade plays out. Now, for some of you that have never used a risk graph before, this is kind of what the risk graph is showing. It shows me that this trade has a $270 max profit and a $730 risk. Now, we will not be risking $730, nor will we be making $270. Our profit target is 50% of this value, which is $135. So we would be looking to make $135 on this trade. As I mentioned before, if we fall below 2760, which right now gives us about an 82-point buffer on the stock, and you can look back and say, well, Ron, the market's down 85 points today. That could hit you in one day. And the answer to that question is yes, it can. We talked earlier about the shorter-term system giving you a little bit less room, but no mitigation or repair, whereas the longer-term system gives you a lot more room, but it also has mitigation and repair rules. If this trade were to go against me, whether it's today, Monday, Tuesday, Wednesday of next week, I would exit the position if the SPX falls below 2760. And that would give me a loss on this position of about $109 per contract. So my target's to make 135. My risk on the trade is now only 109. I am actually higher probability than 50%, and my reward is higher than my risk. That is a beautiful situation to be in. Now, one of the things that people ask me is, well, Ron, what about market gaps? What if the market has a huge gap? Well, I want you to follow that dotted line. That dotted line tells you what your loss would be. Let's assume that on Monday, we have a huge gap over the weekend and the market opens up at 26.50 on Monday morning. Would you lose more than $100? Absolutely. At 26.50, this trade has the potential to lose $500. But that means the market has to gap down over, 175 points. Yes, I know it could happen. But even in this scenario, which by the way, it hasn't happened to us, we still have a much more limited risk in this opportunity. Now, some of our traders don't like to hold these over the weekend. They exit on Friday. That's completely your discretion. But historically, we are placed in good positions with the DEW where the gaps have not hurt us. Okay, so that's an idea of how to set up a trade according to the system. Now, I talked a little bit earlier about risk and reward. The enemy of any income trader is to take losses that far exceed the average gain. Because if you've ever done something like this before for income and selling options, you know that done improperly, one bad trade can wipe out a bunch of winners. That's unacceptable. So you might ask, this right here was probably, in my experience, one of the most volatile times for trading in my 23 years of trading. Now, last summer we had some volatile markets as well, but nothing compared to this. So let's run this system and let's see how the system would have performed during this big market move. So what I did is I ran a test, and this is following what we do in our Ultimate Retirement Solution. Every Monday at 10 a.m., we place an S&P 500 income trade. So using the idea that I just showed you, I did that same approach every Monday, in some cases Tuesday when Monday was a holiday, using a 11 to 25 day option. So what you can see here is the equity curve over the course of the first 5 months of the year. There were 18 trades in total with a profit of $1,125. We had 12 winning trades and we had 6 losers. That's about 66% accuracy. Now that's good, but my biggest goal is reducing risk. So I want you to take a look at the average gain, which is $166 per trade, and the average loser of $145. My gain is much larger than the loss with a 66% accuracy. So even during the great coronavirus sell-off, we still were able to maintain a short, profitable system using income. Okay? That's the beauty of what this can do. Now, by the way, if you're wondering, well, Ron, how much would I need to make $1,100? I base this on one contract. How much money would you have to trade for one, or how much money would you have to have in your account for one contract? I would recommend at least $5,000. $5,000 is enough to trade one contract of the S&P. Now, technically, you can trade more than one contract with $5,000, but we have our methods here. We don't want you risking a ton of money per trade. So I would recommend having at least $5,000 for every S&P contract that you trade. That way, if you have a couple losers, you're not drawing down your account to these monumental proportions. You still have enough to continue trading. Because as you see, there's going to be winners, there's going to be some losses. You never know when the losses will come. You might take 3 losers right off the bat. You don't want to take those losses and draw down your account too much. So if you have more money, Ron, I have $50,000. Okay, great. Now you can trade maybe 10 contracts. So now you have a factor of an $1,100 or an $11,000 gain, okay? Because you can take 10 of these. If you have more, it can scale up as well. So that's a system look back in 2020 here for the first 5 months of the system. So again, I kind of showed you this live, but here was the last trade that we actually closed out. This was a trade that we placed Monday, just this Monday, which was April 25th. This was our trade at 2810, 2800. And you can even see with the market down 80 points today, our strike was at 2810. This trade would actually only be down about $75 right now had you still been in it. But this trade actually made money and was out on April 29th. So you actually hit profits on that trade on Wednesday. You were long on Monday at 10 a.m. Your profit was hit on Wednesday at 12:10. So this trade at a loss really doesn't mean anything. It was actually already out with profits. Now, if this is something that you're interested in seeing more, whether it's the longer term trade that I showed you back in January, the shorter term trade here, both of those systems are great. You just have to find which one you like. Now, the Options Paycheck course teaches both of those SPX systems, in addition to also teaching you how to do this on stocks. So we can focus on both of those markets. So the Option Paycheck course is coming up. It starts May 7th. It's a 7-week, 7-module course. You can see the breakdown of the course week by week. We teach you the basics of options in Module 1, how to place bullish and bearish trades in Modules 2 and 3, how to pick stocks and also the indexes in Module 4 with market timing, how to set up the trade for best probability in Module 5, management plans for how many contracts should I trade, how do I exit trades, how do I repair in Module 6, and then finally Module 7 focusing on the broker side of the trade. Now, also, along with the Options Paycheck, we have a special addendum called the SPX trade, the SPX Paycheck. One trade type, one ticker symbol, one setup rule, one profit rule, one stop criteria. And again, that's based off of what you saw in tonight's presentation. We're going to include that as a bonus. I also include 7 live mastery support sessions. As I showed you, there are 7 modules. What we like to do in those modules is give you assignments to make sure you're implementing the things that you're learning. So we also have a second presentation during the week that allows you to come in. We work through the assignment together, ask any questions, basically allowing you to master the content week by week. We also have a private Facebook community that you are more than welcome to join. If you're a Facebook fan, it allows you to see other people going through the class with you, as well as an alumni forum where every month we get together and have a Q&A session to make sure you're constantly implementing these paycheck principles properly. I will also give you 7 weeks access to my members-only group coaching. I mentioned that on Mondays at 10 a.m. I do an SPX class with my clients that talks about trading the SPX. I also do a credit spread class that focuses on stocks with the paycheck system on Monday at 2. You'll be invited to see those classes where I'm implementing this paycheck concept. I'll give you access to both VectorVest if you don't have it. If you already have VectorVest, which most of you do, I'll also give you access to our Options Pro software. Options Pro, while it's not mandatory to use to implement this system, it does make it a little bit easier. It is your tool for speed and efficiency. That would start the first day of the class. And we'll also, if you're newer to options and you're afraid that selling options is something that might be a little bit more complicated, I'm going to give you a streaming options foundation course. If you sign up for the Options Paycheck, we will activate this right away. Before the class starts on May 7th, you can actually go through the foundations, learn what a call is, what a put is, some of the basics about buying options. It's a real nice jump starter, if you will, into understanding options. You don't need it, but if you want to get a good walkthrough or a good brush up of your option skills, it's something that you can watch before the class starts. Now, give you a summary of our Options Paycheck course, the 7 live modules, 7-week course, the paycheck, the mastery support sessions, the trade recommendation and coachings, our software, Facebook group, and the foundation course. You're looking at a value of $1,600. Now, before I tell you what the price is, I also want to mention that it does have a money-back guarantee. If you take the course, do the work, watch the videos, whether live or recorded, you don't have to do it live with me. You can do it recorded every week from our master archives. If you've done the assignments and you're still not satisfied, I will give you a refund. I like to put the money where my mouth is. I want to make sure that you actually can implement this system. Now, we do have an early bird price right now. It's $9.95. That expires next week. So if you go to www.optionspaycheck.com, you can sign up for the course if it interests you. Again, we can do this on as many stocks as you want, or for those of you that want to implement a very, very quick, time-efficient income strategy, we can do the SPX as well. So again, if you're interested, www.optionspaycheck.com. It's $9.95. The class starts May 7th. And again, live or recorded, you can do it either way with me week by week. I look forward to seeing you in the paycheck class, and thank you guys again for allowing me to teach you this special presentation of the week. Take care, everybody.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.